Every morning, without announcement, a decision is made that affects the price of your mortgage, the value of your savings, and the stability of your job. You didn't vote on it. You weren't consulted. You probably didn't hear about it, but it reached you. It always does. Money doesn't flow randomly through the global economy. It is directed, accelerated, slowed, expanded, contracted by a small number of institutions operating largely outside public view, with tools most people have never heard of, making decisions that touch every transaction on Earth. So who are they, and how much control do they actually have? By the end of this video, you're going to understand exactly who controls the flow of money, the institutions, the mechanisms, and the limits of that control, and why understanding it changes how you read every piece of financial news you'll ever encounter. To understand who controls money flow today, you need to understand how that control was built. For most of history, no single institution controlled the money supply. Gold and silver were mined, coined, and circulated by governments and private banks. Supply was constrained by geology. You couldn't create more money than you could dig out of the ground. This made inflation rare, but economies contracted whenever gold supplies tightened. The system was at the mercy of what was in the ground. Central banks emerged as the solution. The Bank of England, founded in 1694, was among the first. The U.S. Federal Reserve followed in 1913. The premise was simple. One institution with authority over money supply could smooth the extremes, prevent panics, prevent runaway inflation, act as lender of last resort when private banks failed. What began as emergency stabilizers became the architects of the entire monetary system. Today, central banks sit at the top of the financial hierarchy, not because of political authority. Most are deliberately insulated from government control, but because of one unique power: the ability to create money, set its price, and determine how freely it flows. Here is how that control actually works. The primary tool is the interest rate, specifically the rate at which commercial banks borrow from the central bank overnight. This single number ripples through the entire financial system within weeks. When the central bank raises rates, borrowing becomes more expensive everywhere. Mortgages cost more. Business loans cost more. Spending slows. Money creation slows. The economy cools. When rates drop, the opposite cascade unfolds. One number, set by a committee meeting 8 times a year, is transmitted through millions of decisions made by people who never attended that meeting. The second tool is open market operations, buying or selling government bonds to inject or withdraw money from the banking system. This is the mechanism behind quantitative easing. The Fed's balance sheet went from under $1 trillion before 2008 to nearly $9 trillion at its peak. That money suppressed interest rates across the board and inflated asset prices for over a decade. Together, these tools give central banks enormous influence, but not unlimited influence. Central banks can make money cheaply. They cannot force anyone to borrow it. In 2008, the Fed cut rates to 0 and flooded banks with liquidity. Much of it sat as excess reserves rather than flowing into the real economy. You can lower the price of borrowing. You cannot manufacture the confidence required to use it. Control doesn't stop at central banks. There are layers underneath that operate independently and sometimes push back. Commercial banks create the majority of money in circulation through lending. Their decisions about who gets credit and at what price shape economic opportunity in ways monetary policy cannot directly override. Beyond banks, financial markets. The bond market alone is larger than all global stock markets combined. When investors lose confidence in a government's debt and demand higher yields, borrowing costs rise regardless of what the central bank wants. In 1994, bond traders drove up U.S. interest rates faster than the Fed intended, leading James Carville to remark he wanted to be reincarnated as the bond market because of the power it wielded. And beyond that, the dollar's reserve currency status gives the Federal Reserve influence far outside American borders. When the Fed raises rates, capital flows toward dollar assets globally. Emerging market currencies weaken. Their import costs rise. Their debt servicing costs increase. A decision made in Washington transmits economic pressure to countries that had no voice in making it. The flow of money is controlled by multiple layers simultaneously, and those layers do not always move in the same direction. What does understanding this change practically mean? Financial news becomes legible. Every central bank meeting, every rate decision, every chairman's press conference, these are not abstract events. They are adjustments to the most important price in the economy, the cost of money itself. When you understand the mechanism, noise resolves into a signal. Asset prices make more sense. The decade-long bull market following 2008 was not purely organic growth. It was the predictable consequence of near-zero rates making every other asset more attractive by comparison. When rates rose sharply in 2022, asset prices corrected, also predictably. The relationship between monetary policy and asset valuations is one of the most reliable dynamics in finance, and it recalibrates where you place trust. Central banks are not omniscient. They operate with lagging data, imperfect models, and political pressure. Even when formally independent, the Fed described 2021 inflation as transitory for months before the largest rate hiking cycle in 40 years. Control is real. It is also limited, delayed, and frequently surprised. The system runs on money, and the flow of that money is controlled, but not by any single hand. Central banks set the price and adjust the supply. Commercial banks create the majority through lending. Bond markets enforce discipline on governments that overstep. The dollar's reserve status extends American monetary decisions across every economy on Earth. And underneath all of it, the collective confidence of billions of people to borrow, spend, and transact determines whether any of it actually moves. Control is layered, distributed, and contested at every level. What this means, practically, the financial environment you operate in is not random and not natural. It is constructed. The interest rate on your mortgage was set by a committee. The inflation eroding your savings is the output of deliberate policy decisions. The asset prices defining your net worth are shaped by the cost of money itself. You did not design this system. You were born into it. But the people who navigate it most effectively understand whose hands are on the levers, what those hands can do, what they cannot, and what the consequences look like when they get it wrong. The flow of money shapes your life whether you understand it or not. The difference is whether it surprises you.